Edward Conard spent 14 years as a partner at Bain Capital. He led the firm's New York office and oversaw the acquisition of large industrial companies. He joins us at the Heritage Foundation to talk about his new book, Unintended Consequences. Ed, thanks for being with us today.
Thank you for having me.
So I want to begin. It seems that not a day goes by without Bain Capital being in the news, scrutinized some way. Are you surprised by the reaction, and do you think this coverage is fair?
Well, I guess I'm not surprised by the reaction. I think we all expected business to be a central issue in the campaign. I do think, though, that they try to pretend that Bain is doing something different than what business is doing generally, which is trying to make companies stronger, grow them faster, ultimately increasing employment in the process. They want to pretend that private equity is doing something different, but it's not. So I think these are really attacks on business generally that pit employees against employers. It's kind of old-fashioned union organizing in a sense, and they want to pretend that managers only work for investors, Bain Capital only works for investors, but they don't realize that we're all working for the customer first and foremost, and that the customer decides what companies are going to be successful, what products they'll buy, what price they're willing to pay for products, and that ultimately determines which investors will or won't be successful.
So you mean Bain Capital is not a vampire or a job destroyer as the Obama campaign has laid out?
Well, I think they cherry pick examples, but the vast majority of Bain Capital companies' investments were successful. And if you look at the successful ones, they grew 2.5 times faster than the S&P 500. They added about $100 billion of revenue relative to the S&P 500. No one's been able to go back and count up all the employees from this date to that date because no one really has all those old records. So it's been difficult for anybody to put forward the data, but I think it's pretty obvious that Bain has been a major contributor to the success of the U.S. economy.
How would you rate President Obama's performance on economic issues?
Well, I think he has a profound misunderstanding about what drives the growth of the economy and what drives employment in the economy. And I think that by misinterpreting the financial crisis for financial gain and turning employees against employers for financial gain, I think he's done a great disservice to the economy. I don't think he's fixed the problems that have to be fixed. And then on top of that, he's loaded an enormous amount of regulation on top, which increases uncertainty and only exacerbates already a difficult problem of trying to get our economy to grow in the aftermath of the financial crisis. I mean, it's hard to rate that anything but poor, I think.
Now, turning to your book, the subtitle is Why Everything You've Been Told About the Economy is Wrong. What do you mean?
Well, obviously there's a little bit of marketing pizzazz in that title. But one of the things that the book does talk about and where there's been an awful lot of debate is how our economy today differs from the 1950s. And I think one of the lessons you learn in business is that business theory and economic theory generally they're overwhelmed by the specifics of a situation, particularly in business. And if you go back and look at the 1950s, I think you see two things that really aren't accounted for when people say, look at how successful we were in the 1950s. We came off of 2 decades of underinvestment, first from the Great Depression and then from World War II. We destroyed the world's infrastructure. We knitted all our markets into a mass market before the rest of the world did. We employed our population in college before the rest of the world. We killed 500,000 men in World War II on a workforce that was half the size. We had a real dearth of births in the Great Depression. And so there was a real restricted supply of labor at that time. You go, yes, that led to rapid growth and higher growth in wages during that time, but let's hope an awful lot of those things aren't repeated for the sake of mankind. I think the second is when you compare the 1950s economy to today, it was a very manufacturing-oriented economy, really capitalizing on the value of mass merchandise goods. You see companies like Ford Motor Company and Exxon. You had to pave 1 million miles of road. We put 250 million vehicles on the roads. That's really a large companies rule the day, drive investment. It's about funding large-scale capital investments. We transitioned, that economy slowed way down in the 70s and 80s. We live in a world of $1 an hour labor. We transitioned to a local service economy with doctors, nurses, lawyers, teachers, truck drivers, waitresses, whose wages are protected more from the world economy. That's a much more local, entrepreneurial, smaller company-based economy. And from there, that also slows down. We see that in Europe and we see that in Japan, that has slowed to a crawl as well. We have pumped up our growth with innovation, largely from the commercialization of the internet. And today, 13 people can create Instagram and $1 billion of value in 2 years. It's a much more innovation-based, risk-oriented, individual, entrepreneurial-based economy than it ever was.
Now, you've been called a defender of inequality. The New York Times put you on the cover of its magazine. Jon Stewart pressed you on The Daily Show. Business Week came after you. What makes these ideas that you're talking about so controversial or has inspired this kind of reaction?
Well, I think that part of this goes back to my argument about the 1950s. I think if you don't see how much the structure of the economy has changed since then, that a lot of these guys, they kind of scratch their head and they can't explain why income inequality has increased. And so they've all, it's funny, I've debated almost every one of them. Each one of them has a different theory. They don't even agree with each other. If you talk to Joe Stiglitz, he thinks that the rich people are manipulating the government for their own gain. If you talk to Tim Noah at the New Republic, he can't really identify anything, so he identifies everything and says the stars have aligned. This is sort of the perfect storm that occurred, that everything aligned for the benefit of the talented workers. What they don't see is that the economy has shifted and that the talented workers in the United States are much more productive than their counterparts in the rest of the world. That's driven the growth rate of the U.S. economy. We've put 40 million people to work. We pulled 20 million immigrants into our economy because of our demand for employment. We've educated their children. We put tens of millions of people to work offshore. No other high-wage economy has done more for the middle class and the working poor than this economy. But is it driven by the payoffs for successful risk-taking? Yes, it is. Innovation is like looking for pieces in a jigsaw puzzle. You have to find a lot of pieces that don't match to find the one or two pieces that match, and you have to motivate people to take almost certain failure to get a small amount of success, which has driven our economy forward. And if they don't see high payoffs for success, it's unlikely that they will take the risk.